There's no reason to become alarmed, and we hope you'll enjoy the rest of your flight. By the way, is there anyone on board who knows how to fly a plane?
The views and opinions expressed on the Avoiding Real Estate Turbulence podcast are strictly those of the hosts and their guests, and do not reflect the opinions of Century 21 Town & Country, Ross Mortgage, or any of their affiliates.
Hey everybody, welcome to Avoiding Real Estate Turbulence podcast, Season 2, Episode 2. This is your pilot, John Lafferty with Century 21 Town & Country.
And co-pilot Tony Abate with Ross Mortgage, and we are your real estate pilots. Our job is to be your real estate advocate and also make sure you're educated about the buying and selling process. We'll keep you informed throughout until we get you safely closed.
Today's episode is sponsored by Title One. When you're a seller or buyer and you're feeling weary or small with tears in your eyes, Title One will dry them all. They are on your side. If times get rough and friends can't be found, Title One can be your bridge over troubled title issues. You can reach Title One at 734-427-8000 or email them at team1@Title1Inc.com. Again, team1@Title1Inc.net. Did I say com?
Yeah.
Damn it. Title1Inc.net.
There you go. All right. I love the commercial, man. You could go into business and write those taglines, I think. In a real estate transaction, there are many reasons why you can encounter turbulence. Today, we are going to talk all things title with Ken Taylor from Title One. Welcome back to the jump seat, Ken.
Thank you.
Welcome back. Yeah. Glad you're able to join us for Episode 2.
Happy to be here.
All right.
In our last episode, we sort of talked a little bit about how you get into title, why you're in title, and some things about it, what a commitment for title insurance is, owner's policy, lender's policy. So I thought maybe what we do is in this episode, maybe just talk a little bit about some general questions that maybe people have of differences between different ways to hold title and red flags when you're purchasing a property to keep your eyes out for.
Yeah.
Well, first, let's talk about why in Michigan we have split title, what's called split title. And is it a benefit? Is it a detriment? If it's a benefit, who does it benefit? And what does split title mean?
Split title means that in a real estate transaction, obviously you have a seller and a buyer. If taking out a loan, you're going to be purchasing two policies at a closing. The seller will provide an owner's title policy to the purchaser. The buyer provides a lender's title and insurance policy to the lender and mortgage company. What they call RESPA, Real Estate Servicing Protection Act, made a rule that the consumer has the right to choose whoever they want for the service that they pay for. So the seller pays for an owner's policy, so they can choose the title company, whoever they want. The buyer is also paying for a title policy. They can choose whoever they want. Therefore, kind of created this split closing process where each consumer had the right to choose the company that they were going to buy the insurance policy from, or title insurance. In my opinion, this started probably about 12 years ago, was about this real start of the split closing process. I was always of the belief it was a benefit. I'm of the opinion that it does not hurt to have more eyes to look at a scenario. It's two title companies. You're getting research on the property twice. So you are having two sets of eyes, making sure that the history of that property and the transfer of that property is going to go through clean without any liens or encumbrances. So my opinion on it is that it's a benefit. And also the professionals that you work with, your real estate agent, your mortgage company, typically have a strong and good relationship with the title company already. And I think that gives some confidence to your clients that you've worked with the partners, the title insurance companies for a long time, and you trust that they're going to do the best job for your customer. So I believe having a split closing is a benefit to really everyone in the situation. It gives confidence in the client, gives confidence in the agent or the mortgage company that they know who they're working with and that they're going to get the best service and the best policy possible because they know who they're working with.
Give an example of a title company when you've been on pick a side. You've been on the buyer/lend side, and you've been on the owner's policy side of working with a title company on the other side that, number one, they were difficult to work with because you could never get a hold of them, and what they were providing on the other end, there just wasn't a benefit to that other side. Working with a fly-by-night title company or some of these other title companies that we're starting to come across that don't attend closings, and therefore funds get sent overnight. And I've experienced this where you have these fly-by-night title companies. Let's just Jimmy Bob's Title Company and Services, and Jimmy Bob says, well, we're going to save every dollar we can, so the buyer's going to come to our office, and we're going to have them sign all their loan docs here, and we're going to have our funds wired here. Hey, seller and seller title company, we're going to, once we receive the signed docs back from the seller and your title company sends us over the documents, or we send them to your title company, once the originals are consolidated and reconciled, then we'll release the funds to the seller, which if you're closing on a Friday, that means the seller's not getting their check till Tuesday or Wednesday. Meanwhile, do we have a legitimate closing if keys were going to be handed at closing?
Wow.
Yeah, but guess what? The seller's not getting his check until Monday or Tuesday of the next week, and if I'm a seller, I'm pretty PO'd about something like that.
Wow.
Yeah. There are occurrences where we run into newer title companies, ones that have not been seasoned, and you tend to find that you are almost helping them out in a way or helping them along. You are double checking some of the work, and sometimes, you are finding items that should be taken care of at closing that they didn't, which is going back to the more eyes looking at a situation. So it's almost like you're double checking that life of the property. Also, our job is to facilitate the sale for you and your customer. And we want to do so in the most easy and painless way, but also the proper way so that a seller gets their funds the second that they hand over keys, so that, the buyer, doesn't have to, nothing's closed in escrow. So they purchase the house, but then they're waiting to close in escrow for 3 days before they get the keys. So there are times where, we try to go, we do go above and beyond to ensure that your customers are getting what they are supposed to on the day that they're supposed to do. And that's, you do run into that. You hope that you don't. But as you said, a lot of title companies aren't as seasoned as we are, or they haven't been out there as long. So, it's our job. We're representing you and your customer to make sure that everything is done correct and on time as it should be.
Question for you. Let me know if you've ever come across this or heard about this. Buyer seller signed documents and funds have been wired to buyer's title company. So they have the mortgage funds, they have the buyer funds. And before those proceeds are passed over to the seller, either lender says, whoa, wait a second. Hey, we're recalling those funds because we just discovered an issue. Or B, buyer calls title company and says, I want you freezing those funds. I don't want you to release those to the seller. We just walked into the house and the basement's flooded. Or have you ever had anything like that happen?
Yes. Not too often. Luckily, usually by the time you are at the closing table, most of those problems or issues have been worked out. There's been a walkthrough, usually before you go to the table, so that water in the basement takes. But yes, there has been times where, there have been occurrences where either a lender will say, whoa, we just came across something. Maybe that buyer didn't listen to Tony and bought a boat on the way to closing, or there is that water in the basement, and there has been times where we have to either postpone the closing, have to, get maybe re-clearance through underwriting, or maybe an escrow has to be held to move the closing forward. But there have been times where, you have that moment, you get to the table, and we have to figure something out.
I guess I understand that, but what I'm saying is everything is signed. Mortgage docs are signed. Everything's complete. The only thing that hasn't happened is the seller hasn't been given their proceeds yet. Has it ever happened
Yes.
where? So,
Yeah.
okay.
Yeah.
So, in other words, what you're saying is the lesson today is if you're a seller and the buyer and the buyer's title company hasn't sent your funds over to the seller's title company to be dispersed to the seller, or the seller isn't getting a check that day that he's handing over keys, then you probably don't want to hand over keys until you're getting your check, because there's a chance, a slight chance probably, but a chance that the seller may not get their funds. Either A, that mortgage gets recalled, or B, the buyer says, freeze everything. I don't want that seller getting anything because of this. So this is
It does happen. The old kind of rule of thumb is, if you want to think of it as the seller's holding a warranty deed, or the buyer's holding the warranty deed, the seller's holding the warranty deed and the keys, the buyer has cash. The whole purpose is the seller's going to hand the key and the deeds to the buyer's going to give the seller cash. I wouldn't want to be that seller where I hand the keys and the warranty to the buyer. He's keeping the money. That's supposed to be at the same time transaction. So it is very rare in that occurrence where it's made it to that point. But yes,
it's happened.
It's happened before where, you get through everything, and then, right as you're at that, just about to the finish line, there's a red flag that pops up, and then everyone's got to pause and figure out the solution.
I'm not even thinking about, I guess my head is along the lines of, what if the buyer, after they sign their documents and the husband and wife on the way to the property get in a huge fight and decide, that's it, marriage over. I don't want to live in that house. You're not going to live in that house. Hey, title company, we're not buying this house. Freeze the proceeds. We are not going to buy this. Now, could at some point they be forced to move forward with that? Sure, but I mean, I don't know. I'm thinking like doomsday scenarios here, but
I think part of, you are all about satisfying the customer, and you guys do a great job with that. But the core of what you do is ensure that the terms of the contract are met, and if they're met and everybody has agreed to it, you disperse.
Yep.
That's really so. I'd be hard pressed to say that in that window where everything has been signed but not dispersed, I don't think a buyer could legally tell you guys to hold off. I think the buyer's leverage is not signing.
Yeah, that's why it's been. It's very rare that it has happened to that. Usually, it's everything signed, and maybe we got a call from a mortgage company that something else happened. But yeah, as you said, once you've completed signing, typically at that point, you've fulfilled your agreement or your terms of the purchase agreement and your, under your obligation to the note of the mortgage. But, I'd hate to say, I don't think I've ever said, I've never seen that before, because it always pops up. But yes, there has been times where, you're getting just to that finish line and something has popped.
There are nuances, though, because what is that purchaser holding? That cashier's check.
That's correct.
And when does the title company take the cashier's check? At the end. So I can see a scenario where everything has been signed, and the person says, my wife and I just stepped out of the room. We're in disagreement on something. This check isn't leaving my hands. I don't know. I think that's a call the attorney moment at that point.
Yeah, usually that's kind of what it is. It's
because if they don't pass the money, you couldn't disperse.
Correct.
But they have signed everything. To your point, John. Scary.
Well, and that's why these separate closings where, these other title companies, where we're not gonna send a closing person to the seller's closing. You guys are gonna have to get your seller's signed docs, drop them off at us, then we'll cut a check and we'll overnight it, which a lot of times isn't until the next day. By the way, can a title company collect interest on funds that they have sitting in their account maybe over a weekend that you haven't dispersed?
No. All funds that a title company holds are in a non-interest-bearing account. That's a underwriter guideline. They all have to be in a non-interest-bearing account.
Even if it's disclosed in your paperwork that you can collect interest on that?
That'd be nice.
Look, man,
I think it's a legal thing, isn't it?
Yeah,
So-
it can't be held. We can't make money off of other people's funds sitting in an account. So
You're educating me on something here. Have you had title companies basically want to do it remote?
I will not say title companies. I will say that in another state, there is a company, a service. Title does not do closings in this other state that I'm speaking of. I won't mention
Okay.
what state it is. They have a specific service that's called something, and they specifically do closings. They have the buyers sign, they have the sellers sign, and so they handle all that. The lenders wire the money to this service provider. Title just does title in this state. They issue title insurance, owner's policy, they issue lender's policy. That's it. They don't get involved in closings. So in this particular area, there is specific language in their paperwork that says that they are allowed to collect interest on funds that they hold and manage. So what you have happening is, in this particular state, there are deadlines associated with closings. So in other words, hey, Ross Mortgage just is going to be funding this loan, and we're just waiting for funds to hit. Our cutoff for closing is 11:30 this morning, and if we don't receive funds by 11:30, we're not going to be able to close today. And so what'll happen is, if on a Friday, sometimes you're encouraged or not encouraged to have a closing. Oh, it showed up at 11:30. You know what? We're going to have to sit on these funds Friday, Saturday, Sunday. We'll close on Monday. And so what are they doing? They're collecting interest on those funds. Well, can you imagine $200,000 here, $300,000, $500,000 sitting in an account, an interest-bearing account, over 3-4 days, over a period of time? And if you have a collective of over $1 million in disbursements that you need to get out, and you're able to sit on those through the weekend, maybe because people aren't available to do it, you can see how over several months and year, you can collect a pretty good amount of change on that. So this is not legal in Michigan.
Correct.
Let's make that clear. This is not something that is done in Michigan. Title companies do not collect interest on funds that they hold.
correct.
It's like what the guys in Office Space did, isn't it? Kind of like that, where they just took the rounded off or the rolled over interest that in the movie, where they made a lot of money because of this money that just kind of sat
I
unattended.
believe so. They rounded up.
They rounded up, right. Take a penny from the jar, right? So
That's exactly right.
interesting. All right.
Okay, so talked about split title, why we have it. One of the things on our last episode was we talked about title policies with and without standard exemptions. Can you talk about an Eagle policy? What's the difference between an Eagle policy and a standard policy?
The Eagle policy does cost a little more, but what the Eagle policy is it gives further protection than a normal, what they call standard policy. Now, a standard policy, which is still done 90%, 85% of the time, is going to insure both buyer and seller in the transaction, and will still cover all the necessary issues that could arise, post-closing liens, anything like that. An Eagle policy just has slightly more coverage when it comes to post-closing forgeries. The Eagle policy is transferable, which is probably the number one reason that people get it. A standard policy, if you wanted to transfer between a family member, you couldn't. You'd have to get an entirely new policy. An Eagle policy, you can transfer between family members, which is, a little added bonus. But the main difference, is it gives you slightly better coverage post-closing. And there's a very long list of what it does. But they have, and it does cost slightly more, but more and more mortgage or real estate companies I see are going to that. On a whole, probably averages $110 more, so it's not an extreme, increase in cost, but it does give the seller and the buyer slightly more protection after the closing, which is where some of the problems come in. A little more coverage in that regard, and the fact that it's transferable really kind of like people. So in case they want to add their kids onto their house, or want to give it to their kids.
So in other words, where you might want to actually use something like this is mom and dad are elderly. They get a loan on the house. They buy it. It's in Bob and Ellen Smith's name. And then Bob and Ellen Smith want to put it into the trust, Bob and Ellen Smith Trust. They transfer it into the trust. And then mom passes away and they want to add daughter to the title, or maybe they just want to deed it to daughter so she's sole person on title. That's where Eagle policy comes in handy.
Yep.
You don't have to worry about.
Correct. You still have that coverage connected with you because it's transferable between families, which is nice to have.
Well, this is an interesting point because I think we often see kind of the reverse without an Eagle policy. We'll have somebody purchase a property and maybe for whatever reason the spouse isn't in the transaction at the time. Or it's a scenario like yours where they want to add a family member at a later date. Correct me if I'm wrong, but if somebody has a standard owner's policy and then they do that type of conveyance, adding a spouse or adding a child, does that original owner's policy become invalid at that point?
Yeah, at any normal one, it matters. So it matters how you take title or how you purchase a home, because that transfer on a normal policy does void it once you transfer. So it does matter when you do purchase a home, how you purchase it, or what type of policy that you do acquire when you do purchase a home.
And I think a lot of people view that as kind of an innocuous transfer. It's a non-issue.
Correct.
Everyone, same people are living in the house. Nobody has gotten any money or anything. It says paperwork, but holy cow, that's a big event.
Correct.
On Monday you have coverage under an owner's policy, and on Tuesday you don't.
Correct.
Wow.
That's a
We
really
see it.
good point.
We see it, don't we?
Oh yeah,
Yeah.
see it a lot. Where it's not even a thought about the title. Yeah, we'll just quit claim. Just had somebody, mom is elderly, and family decided they were just going to put the daughter on title with mom. I'm sorry, the granddaughter. Put the granddaughter on title with mom just to have somebody on there. While the uproar from the siblings was, whoa. You're putting her on title, but what about me? And what about brother number 2 and brother number 3? This isn't fair. Why are you putting, we should all be on there, or none of us should be on there? So they showed up at our office to do a quit claim granddaughter off. So it was just mom on title again. So no coverage.
Interesting. Yeah. Wow. You were talking quick claims before this episode, and it's probably a segue, because I think this is also something that that folks interpret incorrectly. And I think inside and outside the industry, folks kind of put a deed conveyance all in the same tier as far as validity and everything. But I think you brought up a very good point. There you have the killer warranty deed, and then you have quick claim deeds, and there's others as well. But the warranties and the quick claims are what we see the most. They're not the same, right? Yeah, you want to talk about that a little bit?
Yeah, a quick claim deed is just conveying interest in a property. It just, if I own a house and I want to put, my daughter on it, so I would quit claim it. Just the interest of it transfers.
If any.
If any, yeah, that's true. A warranty deed warrants the condition and the marketable title of the property, and that's what really title insurance stands on. We are taking from that seller a warranty deeds. It's their warrant that they have all the conditions met of the property, or they don't have any liens on the property, and that's what is enforced, usually in court, in that way. A quick claim deed doesn't have anything to stand on. If a seller's not willing to give a warranty deed, I would be leery, because that usually means there's something, maybe something's not quite right. Title insurances across the board, do not rely on quick claim deeds, because there is no assurance from the seller. If the seller's not willing to give that warranty deed warranting the condition and the marketable title of the home, then why would a title insurance be willing to give a title policy? So that's, quick claim deeds are, they're useful in scenarios, but they don't stand up to, any kind of scenario where you would have to fight in court over a claim or anything like that.
Yeah, because correct me if I'm wrong. Right now, I could legally sign a quitclaim conveying my interest in John's house to you.
Yes.
Because basically what I'm saying is any interest that I have in John's house, anywhere from 0 to 100%, whatever I have, is conveyed to you.
Mm-hmm.
Well, I have no interest in John's house. So you have a valid deed, but you haven't gained any ownership.
Correct.
So it's definitely of a different level than the warranty deed.
Yeah, it does. And
I would never do that, by the way. But
Well, you bring up a valid point because it wasn't too long ago where we'd see houses for sale in some hard-hit communities. $5,000 gets you this 3,000 square foot house, and we'd get calls all the time. This house is $5,000. Can you show it to me? And I'd quickly read through and say, "Oh, it's being quitclaim deeded. There's no warranty deed."
Mm-hmm.
Well, I don't know what that means. I said basically what it means is they're going to quitclaim you the house, whether they have ownership in it or not. You're going to pay them $5,000. They're going to disappear, and any liens, encumbrances that are attached to that property are now your responsibility.
Yeah.
Yep.
And they could have zero ownership
judgments.
interest in the house, too.
And have zero ownership interest.
Yeah. It could have, they could have somehow acquired it, even not correctly throughout the chain of title or the history of the property, and they're just going to give you whatever they want, and like I said, run away, and everything that's left in that house, liens, anything like that, is your responsibility now. So the warranty deed is what and that's again back to its standard in every purchase agreement that the seller is going to provide that warranty deed. And I would be leery if a seller said, "I'm only going to do it on a quitclaim deed," because that usually means something's maybe not right through that history of the property, or something needs to be taken care of, and they're not willing to do it.
So really, are they not more accurately or appropriately used for corrective actions?
Corrective actions, typically you see it in more estate planning occurrences where you are going to, we've set up a trust for our family. We need to put the property in a trust. More situations like that. Okay. I would say more, call it estate planning scenarios to get the house into wishes of the family, trust, things like that.
Okay. Interesting.
So let's talk about how you hold title is how you're going to get paid in a real estate transaction. So I don't think most people realize that if Bill and Sally Smith are on title and they're divorced and they sell the house, how are they going to receive proceeds? Or the house is in an LLC or an S Corp or a trust. Can you talk about that and things that people need to be aware of? We run into problems with this all the time. Is the house will be held in a certain language, and they will have an account that doesn't match this language. I just went through this with an owner where they were holding house in a trust, and the way they were holding the house in the trust is how the title company had to make the check out, and how they were going to make the check out didn't match how they were, what the bank account was set up in. And if it's not set up exactly, the bank won't cash that check from the title company. So you're holding a check that you can't do anything with. Talk about that and the importance of getting that correct in the process. Yeah.
And then trusts seem to be the number one occurrence of that. And I think it's a lot of people not understanding, maybe their attorney didn't explain it fully, or, they just didn't kind of think about it after that. Yeah. But, once you transfer your property into a trust, and this is something that sellers always take to heart or find hard to hear, but once you transfer property into a trust, you as an individual do not own that home. You, the entity, the trust itself owns that home, and you are now just the instrument acting on behalf of the trust. Which is why, as a title company, we review people's certificate of trust, and all we're looking for is making sure that you as the individual can act on behalf of the trust. But because of that, once that property is in that trust, the trust gets the money. They own the home. So at the closing table, the Taylor family trust owns it. That's how the check's going to be made out. And a smart rule of thumb that I've always been told from estate attorneys that have talked to me is the second you open up a trust or create a trust, you need to fund the trust, is what they call it. You need to go and open a bank account that matches the name of your trust so that you can take any proceeds, take anything you get from the trust and put it in there. Same thing goes for if you own the house as an LLC. Again, once you transfer that property out of your name as an individual into a corporation, a limited partnership, that entity owns the property, and that's who gets the funds. And that tends to be sometimes a point of contention because you go through the whole process of selling your house and you think, I'm going to get that money. And then you get to the table and you realize your name's not on there, the trust name, the LLC name's on there. And that does, and we've had that happen too, where a seller has gone to a bank and then called us from the bank and say, well, they won't cash my check. And we have to say, well, you have to open up an account in the name of your trust in order to cash it. And sometimes it gets a little heated because they just didn't. And I think it's a lot just didn't know.
Yeah.
And luckily we work with enough, real estate professionals that once they see that and we tell them early property's in the name of the trust, usually at that point they'll tell them, hey, this is how you're going to get your check at the end of it all.
Wow, super critical when there's back-to-back transactions.
Yes.
I'm the seller, or more accurately, my trust is the seller, but I'm selling 123 Elm Street on Monday, and I'm buying 456 Oak Street on Tuesday. I need those proceeds from the Monday closing.
Mm-hmm.
If they can't bank it because they didn't have the account, then the dominoes can't fall, and that second transaction can't close.
Correct.
Yeah. And I think a lot of consumers probably don't think of, I like the phrase you use, fund the trust.
Mm-hmm.
And when folks get that financial advice, hey, we're doing estate planning, let's deed this home into the trust, it'll help you at tax time. That's not considered, a bankable event. And so it's probably an afterthought to open a bank account in the name of that trust until you sell the property. And now you got to put that money somewhere. And Johnny brought up an interesting point about divorce scenarios too. Similar situation.
Yep.
If Bob and Sally own the home, that's what's on title.
Mm-hmm.
That proceeds check,
Correct.
payable to both, right?
Yep.
Is that, yeah.
They still want, how you hold title. If you're still husband and wife, even if the divorce is final, it says that, you are split up, but you're still both on title.
Mm-hmm.
So that check usually goes to both, and typically, either an attorney or the husband and ex-wife are directing us on how to do the funds. But if you're both still entitled, you're both still going to get the money, and that's what people. And it kind of goes in the reverse too as well, where maybe the husband bought the home, just said by himself, the wife wasn't on title, and they keep wanting to say, well, I need to check in both of our names. Well, if you're not in title, you don't have any access, especially with no more dollar rights in Michigan, and you do not have any right to those funds.
Interesting.
The only person who has the right to the funds is who is the registered owner of the property. Whoever that is, entity, individual, that's who gets the money.
Yeah.
I know that title tries to be perfect when it comes to printing up documents and making sure all the T's are crossed and the I's are dotted. And you try to print all these packages up error-free all the time, but let's be honest, when you're doing 30, 50 closings a week, clerical errors and things happen. It's just a way of doing business. What does Title I do if an error isn't caught prior to closing and you're sitting at the closing table and an error is caught by buyer or seller? This isn't right. This needs to be corrected. And if it's caught, then do you just correct it at the closing table and everybody initials the change? And if it's missed and is caught afterward, is there some sort of document that title has buyer and seller sign so that those errors can be corrected and correct in the proper way that they need to be?
Yeah. I mean, obviously, like you said, goal is everything comes out perfect. Everybody, no mistakes are ever made. But nobody is perfect. No one's gone through the life undefeated, as they say.
Do humans work for Title I?
No, we only hire robots.
So humans are not perfect, right? So everybody makes mistakes, and the mistakes happen.
Yep,
but
it does. And we hope we have layers of security in place for us. The file, gets looked at by a good amount of people before it goes to the closing table. But you get to the closing table, and even after real estate agents reviewed it, even if the homeowners reviewed it, it's a quick glance at their closing package. You get to the table, and all my name's spelled incorrectly. Probably the best thing with the advent of technology as it is, it's a quick, I'm going to call the office, they're going to make a quick change, email it right over. Usually it's a 2-second fix, and you're good there. Happens to be something after the fact, no one realized this, and maybe we even went to go record the deed, and there was a typo in the legal description. It got bounced back from the county. Well, we need to get something signed by the seller again. Every company now, no matter what industry you're in, but has some form of errors and omissions or clerical error form that says, hey, we're not perfect. If through the course of this transaction we find something that needs to be re-executed due to an error, you got to work with us to do so. And really 99.9% of the time, everyone is willing to do so and happy to do so, because it's something small, because we have had so many people look at it that it's really nothing major. But it does happen. Again, we're not perfect, but we'd like to think that there's enough layers in between where other people are catching things before it gets to the table. And even if it does get to the table, with technology now, it's so simple to change. It's not like in the old days where if something, it was hand typed, or there wasn't email, we'd have to cross it off and initial it, or we'll get you to sign it tomorrow because I have to run back to the office because that's where the printer's at, because I can't email it here. It's pretty quick nowadays and pretty seamless. And with technology, I think I have my office computer. I can log in on my phone, which is, my wife hates that sometimes, but it comes in handy when I need to correct something. Yeah. So it's pretty easy to make those little minor changes if needed.
Well, just as an example, I had a seller, and they signed one of these error and omission forms that if anything was missed, they agreed to make it right, come back and correct it. When title pulled the taxes, they pulled the current taxes, and when they received the bill, what wasn't on there was that the previous year's taxes hadn't been paid. So at the closing table, when the seller saw the taxes that were taken from their proceeds, they thought, great, perfect. Got their proceeds check, left, called me a week later and said, what do I do? The title company's calling me. They're saying that I have to pay the back taxes. Do I have to? Or can I just blow them off? I said, there's a little form you signed that you agreed to make any corrections or fix any errors or anything that was missed. You need to pay it. And so he went over and he made it whole. But stuff like that happens, but that's why forms like that are in there to catch errors, because sometimes it's the municipality that screws up and doesn't. It's one of the things that we see a lot of is, not so much anymore, but one of the things that we saw a lot of back in 14, 13, 12, 11, 10, 15, 16, we saw homes that were vacant, and in the summer, the grass would be this long, right? And what if let's say it's owned by somebody who maybe bought it at a foreclosure sale, and they're just turning it around to sell it, and all of a sudden the grass is cut. And then 2 weeks later, the grass is cut again. You're like, wow, somebody's cutting the grass. And then you go to close on the property, and maybe the title companies back then didn't realize that all these municipalities said, yeah, we're not going to have these houses with long grass like this. We're going to tag the house, and if they don't cut the grass, we're going to cut it for them, and we're going to put a $150 lien on the property. But it sometimes takes 2 weeks or a month So by the time the title company calls the city and asks for water bill and taxes and anything else that appears on, and by the way, that usually gets attached to the water bill, doesn't it?
Most
lawn
time.
cuttings. So it sometimes doesn't show up. So 2 weeks after closing, the homeowner, sees on his bill, he's got his water bill of $30 plus $150 or $300 for grass cutting or landscaping or whatever. And so that was happening a lot, and it wasn't getting caught because there was a delay for the recording. Right. So a lot of that stuff, you guys had to go back after the sellers to make the buyers whole.
Like you said too, because not everyone's perfect. So sometimes municipalities, like you said, maybe they didn't code in the right amount for taxes, or the water bill wasn't correct at the same time, and so it was slightly more even after escrow was held to pay for a water bill. So there are occurrences and times where corrections need to get made because of outside information that might not be correct. And so because we're relying on public information to help us form the facts for the closing, and sometimes that's not always correct, so it leads to either corrections at the table or maybe a phone call afterwards to say, hey, we got to make this right and move on from there.
Before we go, I wanted to talk about one other thing that's been happening in our industry a lot. It affects your end, it affects my end, and it affects your end, and that's wire fraud. And it's unfortunately become a reality. And these people that commit wire fraud are so sophisticated now that they spoof title companies and send fake wiring instructions. So talk a little bit about that and some of the things that title companies are doing to help combat that, along with the stuff that we do, which is what we tell our clients with regards to wire fraud. But,
yeah, that has been a major increase in worry for us as an industry has been wire fraud. And like you said, John, the level of sophistication that they are now doing and spoofing emails, making it look like, if I'm emailing somebody, they can copy me exactly to my signature line, my email address. And even real estate agents, mortgage, I've heard tales from everyone where mortgage companies, they're getting spoofed. And, as an industry, especially as us as a title company, things we're doing to combat it, secure email. I know it's not something that is an industry that everyone likes to do because it's another step. I got to remember another password, but it's an added layer of protection. We try not to anymore actually email out our wire instructions as much as we can. We encourage always consumers call in, verify, because things you will never hear a title company say, hey, we have these new wiring instructions. That's a big one. And I mean, Title I's been around for almost 30 years now, and we've changed banks once. Title companies do not change banks. So right off the bat, if you get an email, hey, we just changed our bank, be cautious, be suspicious. Or, you're on your way to your closing and you get an email, or you're on your way to the bank because you got your final number and you just heard, hey, the number just changed. In nowadays, and Tony knows too, it's rare that your number just changes. Usually you know it for long enough. We try with secure email. We encourage you to call and verify, get to the bank, make sure that you're calling in because our number, verify our wiring instructions. But it is pretty rampant. I'd say that I get I get minimum 10 to 15 emails a day from people trying to spoof our account, to hack us, to get us to open up so they can get into our system to do that. And I get it from real estate agents that they spoof their account, and mortgage companies too. So it's the rule of thumb: be cautious. I would take 4,000 phone calls a day of someone saying, I need to verify your wiring instructions, versus that call saying, well, I sent it 2 days ago. Why don't you have my money yet? Because, the second it goes to a fraudster, it's gone. And it's something to really, really be cautious about. And, it is scary, but there's you should still have confidence that your money's going to get there, but caution is always the key.
Yeah. Well, the interesting thing too is that it's also at a time when a consumer is in a carefully timed transaction where there's a lot of instructions going on, and I think that consumer is hardwired to think it's very important that I follow all the instructions I get, or I may not close.
Correct.
So they get that spoofed email, and it looks like it comes from me, or it looks like it comes from John. It says, make sure whatever you do, use these wire instructions. They're going to be inclined to do that unless they've received 10 warnings from each of us to not do that, because they want to make sure things happen. And boy, the bad guys are hitting consumers at a really vulnerable time in the transaction. And it's been an interesting progression, right? We were cashier's checks.
Right. We were cashier's checks for a long time. Then a bunch of fraud happened. Then it was, if it's over this amount, we want the rest wired back to.
We don't want wires anymore.
We'll take the full cashier's check pop, and we're just going to verify the funds are good.
Yeah. And at lightning speed, as an industry, title companies went to wire pretty much universally. And then it seemed like within days and hours, the instances of wire fraud just left the launch pad big time. And it's interesting. They talk about the average retail theft or bank theft is in the hundreds or thousands of dollars. Average wire fraud is 5-6 figures all the time. It's huge money.
And that's and then the amount that it affects. If a buyer wires, gets hit with a fraud, not only is that buyer out money, but that seller is out those funds too, and the agent more. I mean, it's a trickle down effect, and it is scary, but you preach caution as much as possible. Always, it sounds weird to pick up a phone in 2020, and no one wants to make a phone call, but pick up a phone, call, say, hey, I'm going to be wiring funds. Can you confirm what your instructions are? I want to make sure that I have them right before I send them.
Talk about avoiding real estate turbulence. That might be the ultimate turbulence that could happen in a deal. The fraud at the tail end.
What a sinking, horrific feeling if you're a buyer and you wire $250,000 and it's everything you have, and it's gone.
Yeah.
And gone.
Because
it's once we've had security advisors. We've even heard of people from the FBI who do this for a living talk about the second it gets to a fraudster account, it's in 6 different ones, and then it's out like that. It's. And with wires, it's hard to pull them back. It's hard to do. So, caution's all right.
Good advice.
Split from 6 different banks: Bank of the Caymans, Kangaroo. Yeah. If you receive the account number to wire to, and it's OU812, don't do it.
Think twice.
Twice.
Exactly.
Well, hey Ken, thanks for coming in again for episode 2.
Not a problem.
It was great having you here. Gosh, I figured the second episode we'd be talking, with the questions maybe 10, 15 minutes, but no, this is great information. Yeah. Thanks again.
Anytime. I appreciate you guys having me out here, and
thanks for sponsoring episode 1 and episode 2, Title 1. Thanks for sponsoring.
Yeah. Reaching Title 1, how can they contact you and the company if the need arises?
Phone number 734-427-8000. Or email team1@title1inc.net. But we're here for any title questions that you have, big, small, any way we can help. We're glad to help.
You guys do a great job.
Well, thank you.
Yeah, absolutely. All right.
Thanks, Ken.
Thank you.
Appreciate it.
Thank you for listening to Avoiding Real Estate Turbulence. If you'd be so kind to subscribe and review and rate, we would appreciate it. Please share with your friends, family, and coworkers that they too can find us on Facebook, YouTube, and AvoidingRET.com, where you'll find our contact information and every episode. You can also find us on Apple Podcast, Google Podcast, and Spotify.